Hey everyone, it is Julie here with TipRanks, and today we're taking a look at 3 strong buy energy stocks that also score a 10 out of 10. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 companies in the energy sector that all come in with a strong buy consensus from Wall Street Analysts. And on top of that, they score a 10 out of 10 on the TipRanks Smart Score. That of course looks at 8 unique different factors and measures a stock's likelihood to outperform the overall market. So today we're going to take a look at these companies, what it is that they do, and what Wall Street is predicting for the stock's future. Just before we get into all of that, this is your friendly reminder that if you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's get right into our 3 strong buy energy stocks. First on the list today, we're taking a look at Weatherford International. Trading under the ticker WFRD, their stock is currently priced at $120 per share. Year to date, the stock has climbed over 23%, and in the last 3 months has gained over 14%. They score a 10 out of 10 on the TipRanks Smart Score with bullish blogger sentiment and positive technicals. Weatherford provides equipment and services to the oil and gas industry and has been doing so for over 80 years. They have operations in 75 countries and bring high-end digital automation technology to bear on the heavy industry of oil patch activities. They work from installing specialized well equipment to bringing oil and gas up to the surface to storing hydrocarbon products before transport. Among some of their unique services is their use of RFID technology to secure wells for improved precision and security, and a single-trip completion system for offshore wells that allows completion of both the upper and lower installations on the same venture. They shared their Q1 earnings report on April 23rd, where they did come out with both an earnings and revenue beat. For their Q1, they reported earnings per share of $1.50, beating expectations by 6 cents per share. On the revenue side of things, it came in at $1.35 billion, increasing 15% year over year, and they also saw their first quarter operating income increase 26%. Just a couple of weeks ago, we had a 5-star analyst from Goldman Sachs weigh in on the stock. They reiterated their buy rating on the Weatherford stock, saying that several catalysts are expected to propel their stock in the latter half of the year. Their strategic capital allocation plan, particularly the initiation of a dividend and a share repurchase program, is projected to serve as a primary driver of value. They also suggest that the company's commitment to reducing debt will substantially improve their interest coverage ratio, bringing it in line with industry peers. The Weatherford stock currently has 7 analyst ratings and does come in as a unanimous strong buy. And the average price target comes in at $155, which would imply an upside potential of 29% from current prices. Looking at our recent ratings down below, our low-end price target does actually come from Goldman Sachs, but still an upside of 19%, while our high-end price target comes from Piper Sandler at $180 for an upside of over 48%. Second on our list today is Matador Resources. They trade under the ticker MTDR, currently priced at $63 per share. Year to date, they've gained 11.65%, but are fairly flat in the last 3 months, up 0.7%. Their 10 out of 10 Smart Score does come with increased hedge fund activity, bullish blogger sentiment, and positive fundamentals. Matador is an independent energy company focused on the exploration, development, and production of oil and gas in the U.S. Based out of Texas, they operate primarily in the Delaware Basin, which is a part of the prolific Permian Basin. They focus on strategic acquisitions, efficient operations, and technological intellect to enhance their resource base and production capabilities. Their integrated business model includes midstream services through its subsidiary as well. The company does pay a dividend on a quarterly basis, which currently comes in at 20 cents per share for a dividend yield of 1.13% and a very low payout ratio at just above 10%. On April 23rd, the company shared their Q1 earnings report, where they came out with an earnings and revenue beat and also said that they anticipate achieving the high end of their 2024 guidance for total oil and natural gas production. Their Q1 earnings per share came in at $1.71, beating estimates of $1.53 per share. Revenue came in at $787.69 million, beating expectations by over $46 million. They saw net cash provided by operating activities of $468.6 million. Recently increasing their price target on the stock was a 5-star analyst from Mizuho Securities. They increased their price target by $5, saying that the firm updated its commodity price outlook through 2026 following the Q1 earnings season. They see strength in global oil prices near term, given higher non-OECD demand and more modest supply gains, but maintain a long-term $75 per barrel mid-cycle Brent outlook. With 11 current analyst ratings, Matador Resources comes in as a strong buy with 10 buy ratings and 1 hold. And the average price target comes in just above $78 per share, which would imply an upside potential of 24% from current prices. Looking at our recent ratings down below, on the low end, we do have a buy, which actually has a slight downside of 1.7%, as the stock has already surpassed that price target, and our high-end price target comes from Siebert Williams at $90 for an upside of 42%. And third on our list is a stock I know I've covered in the past, maybe a few months ago, due to their attractive dividend yield. That energy stock is Enterprise Product Partners. They trade under the ticker EPD, currently priced at $28 per share. Year to date, the stock has climbed over 10%, and in the last 3 months is up 3%. Their 10 out of 10 TipRanks Smart Score does come with increased hedge fund activity, very bullish news sentiment, and positive crowd wisdom. Enterprise is a North American midstream energy company and is one of the largest in the sector. With a market cap of over $60 billion, they operate as a partnership firm, and their activities involve the transport and distribution of hydrocarbon energy sources. They have a network of transport, distribution, and storage assets, including fractionation facilities, deepwater docks, and storage tanks with over 300 million barrels of liquid storage capacity. Their pipeline assets total more than 50,000 miles, and the company can provide natural gas gathering and processing. As I mentioned, the company does pay out a pretty attractive dividend yield, with their most recent quarterly dividend coming in at 51 cents per share for a yield of 7.23%. Their Q1 earnings report came out on April 30th, and while they did beat on revenue, their earnings per share did ever so slightly miss. For their Q1, they reported earnings per share of 66 cents, which fell just 1 cent short of the expected 67 cents. On the revenue side, they came in at $14.76 billion, which beat by $940 million. Distributable cash flow for the quarter came in at $1.9 billion. At the start of May, we did have one analyst from Bank of America Securities reiterate their buy rating on the stock and weigh in. They said that the company's first quarter results were notably robust, driven by better than expected petrochemical margins, which greatly exceeded the consensus expectations. While there were some concerns over capital expenditure increases, they see these as indicative of potential for significant growth, particularly as the company is set to introduce new infrastructure. This growth is underpinned by a solid balance sheet, characterized by manageable leverage and an attractive distribution yield. With 12 current analyst ratings, Enterprise Products Partners does come in as a strong buy with 11 buy ratings and 1 hold, and an average price target of about $33 per share, which would imply an upside potential of over 18% from current prices. Looking at our recent ratings, we have a lot of 5-star analysts weighing in on the stock. On the low end, we do have our buy rating from Barclays here with an upside of 10%, and our high-end price target comes from Stifel Nicolaus with an upside of over 28%. So that is a quick look at 3 strong buy energy stocks, also scoring a 10 out of 10 on the TipRanks Smart Score. Let me know your thoughts on these companies in the comments down below. You guys know I always love hearing from you. Of course, keep in mind these videos are never a suggestion to buy or sell any specific stock, so make sure you do your own research and due diligence. Thanks so much for watching. Have a great day, and I'll see you back here next time.